Something big is happening in Canada's bond market, and it may replicate what happened after the US tariff shock earlier this year. When President Trump announced sweeping new tariffs in early 2025, markets didn't just react to the trade headlines. The real damage showed up in the financial system's plumbing, the short-term repo markets that keep government bonds liquid. Suddenly, the cost of borrowing to hold US Treasuries spiked. Hedge funds, which had borrowed heavily to profit from small bond price gaps, were forced to unwind positions. It was a quiet reminder that even the world's safest debt market can become unstable when too much of it depends on borrowed money. Now, that same pattern is emerging north of the border. Over the past 5 years, the government of Canada has nearly doubled its bond issuance, from about $120 billion to more than $230 billion a year. And the biggest new buyers aren't households, pension funds, or insurers, they're hedge funds. The Bank of Canada's latest data show hedge funds have become the largest buyers of government bonds after the big dealers. They bid more aggressively than traditional investors, but not because they plan to hold those bonds for decades. They're trading on leverage, borrowing cash in the repo market to take huge positions on tiny yield differences, multiplying their returns through debt. It's efficient, it looks sophisticated, but it comes with a hidden risk. When funding costs rise or volatility spikes, those leveraged positions can unwind almost overnight. We can already see the pressure building. Canada's overnight repo rate, known as CORA, has recently been trading above the Bank of Canada's policy rate. That doesn't cause leverage, but it's an important warning sign. When CORA drifts higher, it usually means demand for short-term funding is outpacing supply, often because leveraged investors are borrowing aggressively while dealer balance sheets are stretched. It's the same tension we saw in US markets after the tariff shock. In calm conditions, this setup works beautifully. Hedge funds help absorb record debt issuance and keep auctions looking strong. But in stress, that liquidity can vanish in days. Unlike pension funds or domestic institutions, most hedge funds are foreign. They don't have to stay. If funding tightens or sentiment turns, they'll pull back instantly, leaving dealers and the central bank to manage the fallout. That's why the Bank of Canada is quietly warning that this trend, while supporting debt distribution, also increases vulnerability. The liquidity looks deep, but it's built on leverage, not loyalty. So when you hear that Canada's bond auctions are performing well, remember, a growing share of that demand now comes from the same leveraged investors who just destabilized the US debt market. The hedge fund risk that shook America's bond market in early 2025 may now be spreading north of the border. And as debt loads keep rising, the connection between leverage and liquidity is only getting tighter. This is second-level signals, where we go beyond the headlines to decode the hidden forces shaping global markets. If you found this breakdown useful, like the video, subscribe to Global Notes by JP and hit the bell so you never miss the next signal.